It's 10:47 p.m. on a Sunday. You're sitting at the kitchen table with a spreadsheet open and a cold cup of coffee next to you. You own 2 rental properties, maybe 3, and you're doing math you've done before, but this time you're being honest about it. You're adding up the rent coming in, then you're subtracting the mortgage, then the insurance, then the property taxes, then the maintenance reserve you keep forgetting to include, then the property manager you're thinking about hiring. And somewhere in that calculation, the number that was supposed to change your life starts looking a lot like, not much. You've been told that rental real estate is the path. Passive income, financial freedom. You get tenants, they pay your mortgage, and eventually, at some magical future point that nobody names specifically, you stop needing your W-2. You stop waking up anxious on Monday morning. You stop doing math in your head in the middle of conversations. But here's the thing nobody tells you at the real estate meetup, in the investing podcast, or in the $997 course you bought 2 years ago. Nobody told you how much cash flow you actually need for that to be true. Not a vague motivational number. Not replace your income, the real number. The one that accounts for your actual life, your actual expenses, health insurance, vacancies, capital expenditures, and the actual way real estate cash flows over time when you're being honest with yourself. That question is exactly what this video answers. If you've ever run the rental math and wondered why freedom still feels 10 years away, even though you're doing everything right, subscribe and hit that bell, because this video is going to show you exactly why that happens, what the real freedom number actually looks like, and what most landlords are getting wrong about the metric they're optimizing for. My name is Elena, and I spend way too much time thinking about why people with cash-flowing rentals still feel financially trapped. Today we're going to fix that. Before we get into it, not a financial advisor. This isn't financial advice. Here's what nobody says out loud at the real estate investing meetup. The rent check is not the number that matters. You buy a property, it rents for $1,800 a month. Your mortgage is $1,100. On paper, that's $700 positive cash flow every month. You run that math 3 times, you smile, and you tell your friends you have passive income. But here's what that version of the spreadsheet left out. Property taxes, $250 a month. Insurance, $120 a month. Maintenance reserve, the money you set aside for the roof, the HVAC, the appliances, the unexpected. Let's call it $150 a month. And if you've owned anything for more than 18 months, you know that number is optimistic. Property management, if you use $180 a month. Vacancy reserve, because the unit will sit empty at some point, another $90 a month. Run the real math. $1,800 minus $1,100 minus $250 minus $120 minus $150 minus $90 minus $180 minus $90. That's not $700 in passive income. That's negative $90 a month. The rent check looked like freedom. The actual property is costing you $90 a month to own. Before the water heater fails, before the tenant damages the flooring, before the roof needs work in year 11. This isn't a rare situation. According to data from the National Association of Realtors, the majority of small rental property owners, those with 1 to 4 units, are operating with lower actual cash margins than they report, largely because of inconsistent expense accounting. They're measuring gross cash flow. They're optimizing for a number that doesn't exist. This is the trap. Not that real estate doesn't work. It absolutely does. But most people are measuring the wrong thing, and the thing they're measuring is never going to tell them when they're actually free. Let's start with a principle that sounds obvious, but almost nobody applies correctly. Financial freedom from rental income means exactly one thing. Your net cash flow, after every expense, every reserve, every tax obligation, covers your monthly cost of living, not your gross rent, not your cash-on-cash return on a conference slide, your actual take-home income after everything. measured against your actual life expenses. So before you can know how much cash flow you need from your rentals, you have to know the number nobody wants to sit down and calculate. What does your life actually cost? Not the optimistic version. Not the we could cut back if we had to version. The honest version. Housing, food, transportation, healthcare, especially healthcare if you're leaving employer coverage, kids' activities, vacations, restaurants, subscriptions, clothing, gifts, irregular bills that only show up twice a year. Everything. For a household in the United States, the Bureau of Labor Statistics reports average household spending around $72,000 annually, which is roughly $6,000 a month. But the families I'm describing, the ones who've bought real estate precisely because they want options, and who live in mid to high cost areas, tend to run between $6,500 and $9,000 a month. When you include everything, let's call it $7,200 a month for our purposes. That's the household we're building this entire video around. That is your freedom number. Not $3,000 a month in passive income. Not replace your income as a vague concept. $7,200 per month in actual, durable, post-expense cash flow that survives vacancies, capital expenditure events, and a $6,000 HVAC replacement in August. Sit with that. Because here's what happens next when you run this math honestly. If each of your properties, purchased, financed, and managed the way most landlords purchase, finance, and manage, nets you between $150 and $400 a month in real cash flow, after all legitimate expenses, then to generate $7,200 a month in actual durable income, you need somewhere between 18 and 48 properties. Let me say that again. 18 to 48 properties. That is not passive. That is not freedom. That is a second career with a significantly higher liability exposure than your first one. This is why sophisticated investors talk about something different than raw cash flow. They talk about thresholds. 3 specific thresholds, each one buying you something completely different. Most landlords have never heard this framing, and not knowing it is exactly why people stall. Here's where I need you to stay with me, because the second half of this video is where the math starts doing something genuinely strange. And it actually gets better if you understand what you're truly optimizing for. Ryan is 38. James is 37. They work in the same industry. Both earn around $110,000 a year. Both started buying rental properties 6 years ago. Both currently own 4 properties. Walk into Ryan's home office and you'll see a wall of binders. Unit binders, lease binders, vendor binders, maintenance logs. Ryan manages everything himself. He knows every tenant by name, every unit's maintenance history, every vendor's cell number. He gets calls at 11 p.m. when the garbage disposal breaks. He handles it himself. Walk into James's home office, and you'll see a laptop, a single manila folder, and a surfboard propped against the wall. James uses a property manager for all 4 units. He gets a monthly statement, a direct deposit, and an annual summary at tax time. Here's the number that matters. Here's the gap. Ryan's 4 properties generate $1,840 a month in gross cash flow after mortgage payments. After his full honest expense accounting, taxes, insurance, maintenance reserves, vacancy provision, he nets around $960 a month. He is proud of this number. It took him 5 years of grinding to build it. James's 4 properties generate $1,320 a month after property management fees. He nets around $880 a month. Ryan makes $80 more per month than James. $80. But Ryan is also spending 18 to 22 hours a month actively managing his portfolio, scheduling contractors, fielding tenant calls, handling lease renewals, chasing late rent, showing vacancies. James spends 2 hours a month glancing at his statement. Ryan's $80 monthly advantage costs him approximately $4 per hour of his time. But here's the thing, that's still not the trap. The real trap is this. Ryan optimized for cash flow per property. James optimized for scalability. Over the next 4 years, James used the mental and physical bandwidth he wasn't burning on property management to analyze markets, underwrite deals, and close 3 more acquisitions. Ryan was too exhausted and too stretched managing his existing 4 to pursue a 5th. Every time he thought about buying again, something broke in one of his current units. He never found the bandwidth. James now owns 7 properties. Ryan still owns 4. Ryan's monthly net, $960. James's monthly net, $2,310. Same starting point, same income, same timeline. The gap didn't open because James found better deals. It opened because James understood that the property management fee wasn't a cost. It was the price of the next acquisition. The trap was never the management fee. The trap was measuring per-door optimization when portfolio scale was the actual game. Here's the framework nobody builds explicitly. There are 3 distinct cash flow thresholds in the rental real estate journey, and each one buys you something completely different. Confusing them, or not knowing they exist, is the primary reason investors stall between Threshold 1 and Threshold 2 for years. Threshold 1, cover your housing, $1,500 to $2,200/month net. This is the first genuine milestone. Your rental cash flow covers your own housing cost, your primary mortgage, or your rent. Nothing more, nothing beyond that. At this threshold, you have not achieved freedom. You still need your job. You still need your W-2, but you've removed your single largest monthly expense from your income dependency, and the psychological effect of that is enormous. Research published in PNAS on financial stress demonstrates that housing cost anxiety is the primary driver of financially suboptimal decision-making. Remove that anchor from your psychology and your decision quality across every other financial category improves measurably. This threshold typically requires 2 to 3 well-structured acquisitions, depending on your market and your financing profile. It's reachable within 3 to 5 years for most people starting with $40,000 to $80,000 in deployable capital. Not comfortable, but reachable. What it doesn't do, it doesn't free you. But for the first time, the job feels genuinely optional. That psychological shift matters more than the dollar amount. Threshold 2. Replace one income, $4,500 to $6,000/month net. This is where most people believe freedom lives. At this threshold, one partner in a 2-income household could, in theory, step back from full-time work, or a single person living below their means could. But here's the math almost everyone gets wrong. When you cross this threshold and actually stop working, 2 things happen simultaneously that nobody modeled in the original projection. First, your health insurance situation changes completely and expensively. Employer-sponsored health insurance for a family can cost $400 to $700 a month. Without that employer subsidy, you're looking at $1,100 to $1,900 a month for equivalent coverage on the open market. Second, your tax situation shifts in ways that catch people off guard. The income that felt like replacement income becomes 14 to 16% smaller after self-employment taxes and quarterly estimated payments that weren't part of your previous financial life. The real replacement income threshold is that number plus $1,200 to $1,800 a month to cover benefits your employer used to pay invisibly. At 7 to 10 well-structured properties in mid-tier markets, most investors can realistically approach this threshold. Threshold 3, true optionality, $7,500 to $10,000/month net. This is the actual freedom number. Not because your lifestyle necessarily requires $10,000 a month, your household might run comfortably on $6,000, but because optionality requires cushion above need. And freedom without margin is just a different, more disorienting kind of stress. At this threshold, you can absorb a major vacancy without panic. You can fund a roof replacement without touching personal savings. You can say no to a work opportunity without running numbers first. And this is the one that people consistently undervalue when they're still in the building phase. You can give generously without resentment. This threshold requires deliberate portfolio construction. Not just accumulating units, but acquiring the right properties in the right debt structures at the right stage of the market cycle. The difference between arriving here in 12 years versus 22 years is almost entirely a function of how clearly you understood Threshold 3 when you bought your second property. Let's run a real household's numbers. The Garcias. Combined household income of $148,000 a year. They own their primary residence and 2 investment properties, both acquired in the last 4 years. Monthly gross rental income across both units, $3,900. Here is what they report as their cash flow. The number they share with their family and their investing friends, $3,900 minus their 2 investment property mortgage payments, which total $2,340 combined. That's $1,560 a month. They're proud of this. Their friends think they're crushing it. Here is their actual cash flow. The number that will matter when they try to retire on this portfolio. 2 investment mortgages, $2,340. Property taxes on both units, $580 per month. Insurance on both units, $240. Maintenance reserve at 1% of combined property value annually, divided by 12, $420 a month. They self-manage, but their time isn't free. At a conservative $200 a month for the hours they invest. Vacancy provision at 8% of gross rent, $130 a month. Real net monthly cash flow, $3,900 minus $3,910. They are operating at negative $10 a month, break even at best. They do not know this. They think they have $1,560 a month in passive income. The system, the way most landlords account for their rentals, told them they had $1,560. The system was measuring the wrong thing. These are not irresponsible people. They saved diligently. They did the research. They avoided lifestyle creep. They invested in hard assets the way everyone told them to. But they've been optimizing for a metric that was never going to tell them when they were free, because it was never their real cash flow to begin with. This is not unusual. This is the median real estate investor in America who owns between 1 and 4 units. The honest number, properly accounted, is almost always dramatically lower than the reported number. That's not a reason to quit. It's a reason to change what you measure, starting today. Her name is Donna. She's 61. She's been a landlord since she was 29 years old and has never described her portfolio as passive income. Her phrase, the phrase she uses consistently, is a cash flow engine, built slowly, maintained carefully, and producing reliably once it's been properly calibrated. Donna owns 11 properties. She is not known for finding undervalued deals. What she is known for is one rule that most investors find counterintuitive and often reject. She never counts a property's cash flow contribution until she's been through one full capital expense cycle on that unit. That means she owns the property through one roof replacement, one HVAC system failure, one significant plumbing event. Once she's absorbed the major unexpected expenses and recalibrated her reserve calculations based on reality rather than original projection, only then does she count that property as a stable contributor to her monthly cash flow. The unsexy detail: Donna's properties look mediocre on paper in years 3 through 6 of ownership. Capital expense events eat her reserves. She's not bragging at meetups. Other investors look at her year 5 numbers and assume she made poor acquisitions. By year 8 to 12, after the major systems have been replaced and her real ongoing reserve requirements are known quantities rather than estimates, her properties generate more reliable net cash flow than nearly any comparable portfolio in her market, because she's not holding inflated reserves for events that have already been resolved. The HVAC has been replaced. It won't need replacing again for 15 to 18 years. That reserve line moves to near zero on that unit and stays there. Donna's 11 properties generate $9,400 a month in net cash flow today. She did not get there by finding great deals. She got there by surviving the difficult years without panic selling, measuring honestly through every stage, and recalibrating after each capital event based on reality rather than assumption. The lesson in one sentence. The landlords who reach freedom are the ones who measure cash flow honestly from the very beginning and remain patient enough to let the real, durable number reveal itself over time. What to actually do, the 4 steps in order. Step 1. Run the honest number on every property you own. Not gross rent minus mortgage. Every dollar going out the door, mortgage payment, property taxes, insurance, maintenance reserve at 1% of property value annually, vacancy reserve at 8% of gross rent, and management cost. Whether you use a property manager or not, your time has value. Assign it a number, total it all up, subtract from gross rent. That is your real cash flow today. Write it down. Most people discover a number they didn't expect. That's the starting point, not a reason to stop. Step 2. Calculate your actual personal freedom number. Your monthly household cost of living, honestly tallied, including everything that shows up irregularly. Add $1,400 a month if you plan to replace employer-sponsored benefits. Add a buffer of 15% for the expenses you inevitably forgot to include. That final number is the target your portfolio has to reach. Specific, yours. Written down. Step 3. Calculate the gap and the real timeline. Divide your freedom number by the realistic per property net cash flow in your market for well-structured acquisitions. Typically, $400 to $600 a month per property in most mid-tier markets. That tells you how many properties you need. Divide by how many you can add per year. That is your honest timeline. Most people doing this math for the first time are 3 to 9 years from threshold 3. That is not a discouraging number. That is a plan. A specific number with a specific date is a project. Step 4. Optimize for scalability, not per-door cash flow. The Ryan versus James dynamic plays out in virtually every landlord's portfolio eventually. The investors who remove themselves from daily operations, even at a real cost to monthly cash flow in the short term, are the ones who find the bandwidth to add unit 5, 6, and 7. The ones who self-manage forever tend to own 4 properties forever. There is no trophy for being the most hands-on landlord. There is no moment when your diligence as a self-manager converts into freedom. Freedom arrives when the net cash flow number crosses your specific freedom threshold. Everything between now and then is just how fast you get there. The boring choice is not the consolation prize. It is the strategy. The investors who end up free from their rentals are not the ones who found the best deals or closed the sharpest negotiations. They are the ones who knew exactly what number they were building toward, measured honestly at every step, and stayed in the game long enough for the portfolio to do what it's actually designed to do. The gap between the landlord who works forever and the one who reaches real optionality did not open at year 12 of their investing journey. It opened in 100 small measurement decisions across the first 3 years. In the maintenance reserve, they included or left out. In the management cost, they counted or rationalized away. In the second property they purchased because the first looked like great cash flow on a spreadsheet that was measuring the wrong thing. Real freedom from rental income is not about owning more units. It's about owning enough genuinely cash flow positive units to cross the threshold your specific life requires. You already know what your life costs, now you know what the portfolio has to generate. Here's the hard truth about YouTube videos. This one can show you the framework. It cannot run your actual numbers. Knowing your freedom threshold is step 1. Building the specific portfolio structure that gets you there. The right markets, the right debt ratios, the right property types for your timeline, that's a longer conversation. And if this video surfaced a number you hadn't seen clearly before, drop it in the comments. The investors who get there don't do it alone. And this community is where that conversation belongs. Like, subscribe, and I'll see you in the next one.